Understanding the 2008 Financial Crisis, a 10-minute overview. Welcome to our channel, Stories by Latif. The financial crisis of 2008 was a pivotal event in modern economic history, marking a period of severe turmoil in global financial markets. This crisis, also known as the Great Recession, was triggered by a series of complex and interrelated factors, leading to widespread economic disruption and profound changes in financial regulation. In the early 2000s, the U.S. housing market experienced a boom, driven by low interest rates and an increasing demand for real estate. During this period, lenders began offering mortgages to borrowers with poor credit histories, known as subprime borrowers. These subprime mortgages were seen as high-risk loans, but they were believed to be safe investments due to rising home values. As home prices continued to climb, both lenders and investors were optimistic, believing that even if some borrowers defaulted, the rising property values would offset potential losses. By 2006, the housing market began to slow, and home prices started to fall. This decline in property values led to a wave of mortgage defaults, particularly among those with subprime loans. Homeowners who had purchased properties at inflated prices suddenly found themselves with mortgages greater than the value of their homes. As defaults increased, the market for mortgage-backed securities, financial products based on these risky loans, began to unravel. The resulting losses for financial institutions were substantial, as these securities had been widely traded and held by banks and investors globally. The crisis reached a critical juncture in September 2008 with the bankruptcy of Lehman Brothers, a major investment bank. Lehman Brothers had been heavily involved in trading mortgage-backed securities and had accumulated significant losses as the value of these assets plummeted. When the firm could not secure additional funding or find a buyer, it filed for bankruptcy, marking the largest bankruptcy in U.S. history. The collapse of Lehman Brothers sent shockwaves through the financial system, leading to a severe contraction in credit markets and a sharp decline in stock prices. In the wake of Lehman Brothers' failure, panic spread through financial markets worldwide. Banks became unwilling to lend money to each other, leading to a liquidity crisis. Businesses struggled to access credit, and consumer confidence fell sharply. The interconnectedness of global financial markets meant that the crisis quickly spread beyond the U.S., affecting economies and financial institutions around the world. Stock markets plunged, and governments were forced to intervene to prevent a complete collapse of the financial system. In response to the crisis, governments and central banks took unprecedented actions to stabilize the financial system. In the United States, the government enacted the Emergency Economic Stabilization Act in October 2008, which allocated $700 billion to purchase troubled assets and inject capital into banks. The Federal Reserve also played a crucial role by lowering interest rates and introducing emergency lending programs to provide liquidity to the financial system. These measures were designed to restore confidence in the banking sector and prevent further economic decline. The aftermath of the crisis revealed significant weaknesses in financial regulation and risk management. In response, the U.S. Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This comprehensive legislation aimed to increase oversight of financial institutions, improve transparency, and protect consumers from abusive practices. The crisis also led to increased scrutiny of global financial practices and a broader discussion about economic inequality and the need for systemic reforms. The road to recovery from the 2008 financial crisis was long and challenging. The global economy faced a prolonged period of slow growth, high unemployment, and lingering financial instability. However, over time, economies began to recover, supported by coordinated policy responses and gradual improvements in financial markets. The lessons learned from the crisis continue to influence economic policies and financial regulations, emphasizing the importance of risk management, transparency, and regulatory oversight in maintaining financial stability. The 2008 financial crisis was a defining event that reshaped the global economic landscape. It underscored the interconnectedness of financial markets and the potential risks associated with complex financial products. Understanding the origins, impact, and responses to the crisis provides valuable insights into the importance of robust financial regulation and the need for vigilance in an ever-evolving global economy. As we move forward, the lessons from this crisis remain relevant in guiding policies and practices aimed at preventing future economic upheavals.